Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, June 6, 2017. This video will be a follow-up to the post I made yesterday, the market update, in which I posted on the front page of the site the near-term analysis for the SPY, SPY, QQQ, and IWM using 10-minute charts, 10-minute time frames. And I made mention in there that I have even a better read on the 60-minute charts and see some interesting developments. So this video will be relatively brief. I'm only going to stick with the 60-minute charts here, and I'll cover a total of 6 securities. We'll look at QQQ, the NASDAQ 100 tracking ETF, as well as what I refer to as the FAAMG stocks, FAAMG, Facebook, Amazon, Apple, Microsoft, and Alphabet, symbol GOOG. So we'll go over those charts, and that's it. Take a look, and I think a lot of these, they're poised to play out possibly today. I'm starting this video in pre-market. In the futures, we're indicate the gap down a little bit, nothing major, just a slight gap down at the open. But then again, as I made mention yesterday, there are some significant developments worth mentioning. So let's go ahead and dive in here. We're looking at QQQ 60-minute. I left this chart as is intentionally. I think the last update I would have posted on the site probably had this divergent high pointed out back here. You can see these lines. In fact, each of these lines are divergent highs. They're not all drawn out anymore. I may have removed some of the trend lines, but you can see there that we've had a series of divergent highs, and yes, the overall trend has clearly been bullish, but within there you have these minor pullbacks, a little bit bigger pullback, and pointed out that last divergent high here. Now this is technical analysis. Divergent highs, play out most of the time, but not all the time. I always make mention, at least 90% of the time, I would say. And there are times where the divergence is burned through, meaning you take out the previous reaction high in your indicators and oscillators that you're using below. So in other words, right now, all we have, and this is why I left it here, is just an extension of that previous divergent high. So that doesn't mean that it's not going to play out. It certainly didn't play out for much of a pullback there, but we still have divergence in place. You can see we can very easily and clearly extend these lines. That divergence, if the pre-market trades hold and we do gap down at the open, as you can see, the PPO is right now poised or essentially crossed or was about to cross over at the close yesterday. So we'll have what I call confirmed divergence once we get that bearish crossover on the PPO. I like to see that because then that officially puts in that lower high. So as you can see, this is a slightly downsloping line, as is this line on the RSI. Flat to down sloping, and it can be a flat line as well on the indicators as long as you don't have a higher high. And in this case, you have very much higher high in prices. That's what you want to see. That's negative divergence with the indicators, oscillators making lower highs while price makes higher highs. And so that's that. So clearly, again, we just have to sometimes, I always say the charts are dynamic, not static. They do change, and as they change, so will the analysis. And, there's a possibility these divergences are burned out. If and when we put this line at horizontal, if that PPO and the RSI and this 1333 histogram here, whatever you're using, stochastics, doesn't matter. Once those the previous highs are taken out, we no longer have divergence. Okay, enough on that. I know most of you know what divergence is. I just want to talk a little bit about it and how I use it. So now here we have a little support level. There's a gap. What was that, yesterday or the other day? Little support right here around 141.84. But now we have a pretty clean bearish rising wedge pattern. And that's something to watch out for. If it breaks, any or all of these are support levels. I still think at the very least, just eyeballing this chart, we'll probably come back down to this level here. We have a trend line, horizontal support level around 136.54. A very shallow early pullback target. I mean, if this market has a lot more left in it, especially in the near term, then maybe look just for if this trend line breaks, tested this support level here. Again, it's up to you. If you're bullish, these are the levels you want to go long on a pullback. We're going to have a little weakness, at least at the open today. Who knows? They could buy that up in a matter of minutes, or markets can sell down. So those are the levels that I'm looking at on the Qs. But more importantly, let's look at the FAANG stocks. to kind of get an idea of where this market's going to go. I'm going to start out here with Apple, and this is a 60-minute chart. I have to go back to a 2-hour time frame on TC2000 just to go back in time. That's one limitation. I think it's 200 bars. So a 2-hour, 120 minutes each candlestick. And you can see just a very, very well-defined uptrend line. Numerous reactions on this trend line, and we're dancing on it now. So again, I just wanted to go and show you where that trend line generates from back in November, early November, so you can see all the reactions. And here it is. It comes in here on this 60-minute chart. You can see it better. We're dancing right on it. We had a touch right here, a reaction, reaction there, reaction, lots of reactions on this trend line. And Apple, came out yesterday with some announcements, competition to Amazon Alexa, their new little home gadget where you talk into, and they use Siri. Obviously, the market was not too excited about that. A new iOS, what's new? So we'll see. Anyways, it just seems like Apple may have gotten a little ahead of itself, but it's hard to argue the validity of this trend line again. And I'm going to go back on my word and just look at the daily chart real quick. I told you I'd stick with 60-minute charts because this is important. Remember, 60 minutes and in those 10-minute charts I put up yesterday, the shorter in time frame you go, the quicker the buy or sell signals are, but they're also more prone to whipsaw signals. Daily, the longer you go out in time frame, like a daily or even a weekly chart, those are more technically significant levels. If you have a break, and I've pointed this trend line out for quite some time now. It's the same trend line we just looked at a minute ago on a 2-hour time frame, and I've been pointing this out on the daily time frame, pointing out this clear, well-defined uptrend line, very, very clear and powerful negative divergence. Just as we had negative divergence back here, it led to a 12% correction. We had negative divergence back here, it led to a 31% correction. And I'm still looking for, from where we're at right now, let's see if that, yeah, we're still, we'll call it 13, 14%, so about 18% if we drop to that 127 level. And there's also a target here. If you're uber bullish on Apple, here's where you want to buy, around 145, 70 or so. That's certainly here, I'll put up the number there. That would be the first area where I'd expect a reaction. But ultimately, I still favor a move down here. And as you can see, we're dancing right on that line. That's the same uptrend line I showed you on the 60-minute chart. And, it's no surprise that Apple went up this high. I've been pointing out that trend line for a while. In fact, if we look at this chart right here, this was posted back on May 1st, so over a month ago, about almost 6 weeks ago now. And at the time, I said from the posture on the PPO and RSI, as well as where Apple is trading in relation to the rising wedge pattern, it appears as if Apple needs one last thrust higher within the wedge before breaking down and below, confirming the potential negative divergences that are forming. So you can see here, I drew a scenario. You see the line up there, trend lines up there. So I had the RSI, the PPO moving up, rolling over, turning back down. Price is making one last thrust up. We were at 146.45 back then, and here we are today at 153.93, and that's exactly what happened. RSI, PPO, RSI went up to where I had those trend lines, rolled over, put in the confirmed negative divergence there at the highs. And so far that remains the highs. It was a divergent high, and it's meshing with what I'm seeing on the 60-minute chart. So, I'll either be right or wrong, but this is what I've been doing for years, and I understand, and I've heard it, believe me, from many of you, that, a lot of these divergences in recent months, even for, going back 4, 5, 6 months, even into the end of last year, haven't played out, or they did play out more accurately, but for very minor and shallow pullbacks. But again, you do this long enough, it's the same things that have always worked in the past. As I said, nothing is 100% effective, but these divergences, and especially in this case, have only grown larger on most of the indices or individual stocks. Some have been burned through, but now at this point in time, we have a different set of divergences we had back here. So again, a lot of these divergences were pointed out and already did play out for corrections. So take it for what it's worth. That's what I see. So here's Apple, world's largest company, largest component of both the S&P 500 as well as the NASDAQ 100. And it's dancing on that trend line. And by zooming down to the 60-minute charts, you can see that trend line there. Go down to the 10-minute chart. Let's see if I have anything for you. No, not a whole lot. All right, let's move on and look at the rest, and we'll wrap this up. So here's Alphabet. There's two share classes. We'll just look at this one, GOOG. This is a very, very clean bearish rising wedge. You can see clean. We don't have any false breakdowns. We have several reactions up top within the wedge. Negative divergence. We had a little smaller wedge, if you will, or a smaller trend line here with very minor divergences. It only spanned a couple weeks, and it did play out for a pullback. You know, you could, if you're a short-term trader, 2.5%. Short trade on Alphabet or go long at the trend line, stay long until this wedge cracks. But at this point, based on where prices are in proximity to the apex of the wedge, this is what we call, this is a sweet spot right here. If this wedge is going to break down, it'll do so soon. And if it happens, if Alphabet happens to make a new high, just as I did on QQQ in the beginning, you can extend these trend lines and see that that divergence is still well intact. In fact, we may even have a little bit steeper divergence here. At this point, we actually do. I can draw that divergence. Is how I should have extended it. So there's the divergence, and there's still room for it to go up a little higher. However, everything seems to be right on the verge of where it's about to break down. And again, we're talking the 60-minute charts here. We're not talking the end of the bull market. Although I'll be very clear that that's going to come any day now. We're already well into the second longest bull market in the history of the U.S. financial markets. We've never seen one. There's only one bull market that's outlasts the current bull market. So it's just a matter of time. Valuations are at extremes, all that other stuff I've talked about. So one of these will be the real deal, and well, we'll see. But for now, let's just live in the world of the 60-minute charts, pull back this first target if you trade Alphabet. That's good for almost a 6% gain. T2, if we drop there, that's about 7.8 or so, almost 8%. And if we happen to backfill that gap down below, that's about a 10.5% drop. So correlate that with the NASDAQ 100. That's right now what I'm eyeing. And we'll go from there if it happens, and I'm talking over the next few weeks or so. Maybe we get that whole sell in May go away thing starts to play out. Maybe not, but I call them like I see them, guys. That's it. So this is what I see right now. Microsoft is interesting. We had a divergent high right here, and we blew through there. This sort of looks like a blow-off top. We'll see. We'll see what happens, but we had this sharp ramp recently. Maybe a wedge overshoot. A wedge overshoot is what I refer to when you have a rising wedge like this. Prices briefly pop above the wedge and then come back down. Either way, we've taken out those divergences just by a bit. You can see if I put a horizontal line, we've just taken out that previous reaction high there and just about all the indicators. So either way, that's Microsoft. That wouldn't be my first stock to short, but then again, sometimes these blow-off tops and these overshoots, they come back with a violent reaction back down through the wedge. You might want to extend that yet. You could extend that trend line to look something like this. I'm not crazy about that trend line. It doesn't have a lot of reactions, nor am I crazy about I don't have a very strong read on Microsoft. Here's Amazon. Great company, but getting a little stretched. It's always been, and it is, pretty overvalued right now. And, stock market's not about how good a company is, what their earnings are like, what their growth rate is like at the time. It's just you get too many buyers. Everybody's bullish, everybody's long. Then the supply dynamics are temporarily upset. At that point, you have nothing left but willing sellers. And so you get profit taking. And either way, sooner or later, you can debate that all day long, but it's hard to argue the merits of this trend line. We have one little whipsaw signal right here, false breakdown, but if you go back on this 60-minute chart, you can see numerous reactions all the way back here to March 27th. Pretty valid trend line. It takes the form of a rising wedge, negative divergence. Those divergences have steepened recently on this on the recent thrust, the last thrust higher at this point here. So there's your sell signal. And what I like, and the reason I'm doing this video, these all, other than Microsoft that didn't have a great trend line, these charts are in alignment. Apple's ready to crack. It's sitting right on its, daily and 60 and 120-minute trend lines that I covered, as is Alphabet, GOOG, which I just covered, is close to breaking down on that wedge, closer to the top, like Amazon, so a little bit of downside, but if you see these FAANG stocks, all 5 of these stocks crack, or even 4 out of the 5, that makes up the majority of the returns of, or nearly half of the returns of the NASDAQ 100. That's been our leading index. So if these stocks crack, it's safe to say that the market cracks. And finally, we'll wrap it up with the first of those, which is Facebook. And you can see here, same story, and that's the common theme. That's why I wanted to do the video. There's a divergent high, very clear. We had a divergent high. No, we didn't have one at that point. See, prices were higher here. That wasn't a higher high. This is a higher high. So that put in, at this point here, at the recent high, negative divergence for the first time in quite a while on the 60-minute chart. We might have had some divergence. I can't see to the left of the chart. Maybe back here, played out for a little pullback. Targets, I have a lot of lines here, and I'll be honest, I haven't cleaned up this chart, but I'm looking at a thin zone, and this is common. I probably should have went over that on a lot of the stocks, including Apple. You look at the volume at price histogram, that's this indicator here, these green and red bars, you can see they come all the way out to here. At this point, it's pretty thin, down to about right there. I'm probably doing injustice here by covering it with a white shaded box. You can't really see those. Let's see if I take this tool. Okay, I have another tool here. So you can see these bars coming out to here, and down here you have an extension. One of these bars comes all the way out here. So this area in the middle right here, this is a thin zone, meaning not a lot of trades occurred at that point. In fact, I'll give you a clean board. You'll see it a little bit better without all the trend lines, and we'll turn this volume price up so you can see it real well. There we go. All right, so this is our thin zone right here, and that thin zones work a lot like gaps, if you will. So this looks like, and you can see there's a gap back here. There's quite a bit of support. There was a gap. That gap was back tested from above. It was backfilled and then some. We moved back up, but this still remains a thin zone. So we could expect something along the lines of this. You know, if Facebook does come back in, maybe it finds support around somewhere here around the top of that thin zone. And then if it gets into the thin zone, it will likely backfill the thin zone, similar to a gap, and that would act as support. If that is the case, then we're looking at a pullback of roughly 7.5%. And that somewhat meshes with the give or take 10% pullback I'm looking at in QQQ. Again, it won't happen overnight, but who knows? There's a lot of, the thing about this market is volatility has been so compressed. I had a friend share a fact with me today. Let me see if I can find that. Hold on one second. Okay, here's the stat a friend of mine shared. He's also a member of the site. Since 1990, the S&P 500 has had 15 trading days with intraday high to low ranges narrower than 0.25%. 4 of those have been in the last month. That's impressive. I haven't verified those stats, but he's a sharp guy, and I'm sure he read that somewhere and recently. And it makes sense. I've talked about, we kind of joked about in the trading room last week about the markets being closed for 4 or 5 days, beyond the Memorial Day holiday, because it looked as if nothing was happening. The markets weren't even moving. They were flatlined. And typically from those periods of low volatility, often come explosive price moves, a pretty sharp price move. So same story, right now I'm seeing, at least I haven't seen that in a while. I shouldn't say same story. I was going back a month or so saying that Apple looked like it needed another thrust up. And, we had those 10-minute trend line breaks late day Friday that I posted in the trading room, followed up with that yesterday. Those are early sell signals. So far, we're following through on the downside, and I had some more additional downside targets. We did hit the first target in the IWM yesterday. And now let's watch for these more significant 60-minute trend line breaks. If you see 3 or even 4, especially 5 out of those 5 FAANG stocks break down, then it's safe to say that we're probably headed lower, at least for a tradable correction. And that's all we're looking at here, guys. It's been, trading the market is tough. And on a side note, and keep in mind, trading the market makes up for a very, very small percentage of my overall trading. I trade individual stocks more so than the market. But with that being said, there are opportunities, and I know a lot of traders prefer to trade the markets because they're diversified, very liquid instruments like SPY, QQQ, NQE minis, ES, things like that. E-mini futures or whatever your vehicle is. So you don't have to get a lot. You can have a 3, 4, 5% pullback. You can have a 1% pullback in the market to make a ton of money on trading the E-minis because they're so leveraged. So it all depends on your time frame and trading style. All right, let's wrap it up here, and we'll see what happens with those 60-minute charts.